Could a few simple shifts help you surpass the S&P 500 forever? When you overcome these obstacles, feeling overwhelmed by information, not knowing which companies to pick, fearing losses, struggling with company analysis, doubting whether you can beat an efficient market, and carrying scars from past failures, you free yourself to make clear, confident moves. You'll save time, grow your understanding of the market, and ultimately open the door to achieving returns that surpass the S&P 500. Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where you arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. By tackling today's biggest investing roadblocks, you'll not only gain confidence but also discover a clear path toward consistent, market beating returns. Stick around now. Stop drowning in daily headlines. Here's the overlooked strategy to sift the noise and surge ahead of the S&P 500. One of the biggest barriers investors face in the overload of data swirling around them. News headlines, social media posts, and constant market alerts can make your head spin. It's like standing in the middle of a busy intersection with cars honking and zooming by from every direction. Each piece of information claims to be important and might feel guilty if you ignore it. When you're overwhelmed, you can't see the bigger picture. Instead of focusing on core insights, you get stuck on noise. This is where many people get lost. They want to beat the S&P 500, but they drown in a sea of meaningless details. The limiting belief often sounds like this: there's too much conflicting data, and I'll never figure out which information truly matters. That belief can hold you back from making logical, timely choices. You could end up second guessing every step, or worse, doing nothing at all. But you don't have to stay trapped. Think of the markets like a complex puzzle. You only need a few right pieces to see the full picture. So, how can you find those crucial pieces? Let me share a creative strategy that I've discovered through my own journey. I call it the precision filter technique. Normally, people rely on general investment newsletters or random stock tips from chat rooms. Instead, gather a small set of reliable sources, maybe two well known financial publications, and train yourself to look for certain key factors. For instance, check each company's revenue growth trends, profit margins, and leadership track record. Don't pay attention to everything else. Keep your routine simple. Each morning, scan only those factors in your chosen sources. By doing this, you force your mind to filter out noise and focus on what truly drives a stock's performance over time. But here's the twist nobody talks about: set a timer for your research. Give yourself, say, 15 minutes a day to look for updates on your chosen key factors. Once the timer goes off, you stop looking for more news. Why? Because your mind needs boundaries to stay effective. If you allow unlimited research time, you'll drift into random headlines and hype. By limiting yourself to those 15 minutes, you'll become sharper at spotting real opportunities. This direct approach might seem simple, but it's surprisingly powerful. I've practiced it myself, and it helps me zero in on the essentials. It also frees me up to do the real work of investing, thinking about a company's true worth, rather than chasing the latest buzz. Now, let's talk about the benefit of overcoming this objection. When you're no longer overwhelmed by information, you gain clarity. That clarity acts like a compass, guiding you to the stocks that matter. You become more confident in your decisions and you stop jumping from one hot tip to another. In the long run, clarity saves you money by preventing impulsive trades. It also saves you time, which you can use to refine your strategy further on or simply enjoy life. In short, breaking free from information overload means you can start making moves that actually surpass the market. Look, I've studied many economic cycles, and one key principle is that too much input can muddle your thinking. By using the precision filter technique, you create a protective shell around your mind. You only let in what's vital, and you block the rest. It's not about ignoring the world, it's about being selective. By narrowing your focus, you uncover insights that other investors miss. That's how you get ahead of the S&P 500. So, the next time you feel drowned by data, remember, you don't need to chase every story. Pick your trusted sources, track only the metrics that impact long-term stock performance, and set a strict time limit. This approach gives you an edge that most people overlook. They'll keep scrolling aimlessly, but you'll be guided by a clear method. In the end, that focus can truly mean the difference between matching the market and surpassing it. Scared to pick the wrong stock? Paralyzed by a massive watch list? Learn the hidden method that conquers choice overload. Many people want to beat the market, but they freeze when it's time to choose specific stocks. They see a long list of companies, and none of them stand out as a sure bet. This uncertainty can feel paralyzing. You might think, how do I pick up the right ones without risking everything? Before you know it, you're either spread too thin or you end up sticking to index funds and hoping for the best. The limiting belief here is I don't have a solid system for choosing stocks, so I'll never pick the right companies consistently. This belief grows stronger each time you see new tickers, new trends, and new rumors. It feels like standing at a crossroads, not knowing which way leads to success. But I've learned that instead of trying to be an expert at everything, you only need to master a few critical steps. Picture a circle that contains a few industries you understand well or find fascinating. Maybe you're intrigued by consumer tech, healthcare, or renewable energy. Don't try to cover all sectors. Instead, go deep into the ones you genuinely care about. Why does this work? Because real expertise comes from interest. When you pick areas that spark your curiosity, you'll naturally do better research. You'll also spot opportunities faster than someone who's only half paying attention. And that's how you create an edge over the broader market. Now, here's the twist that's often overlooked: become an observer, not just a reader. It's not enough to skim quarterly reports and watch talking heads on TV. Instead, track how these industries affect people in real life. If you're studying consumer tech, talk to friends about the gadgets they use. Ask them what makes their life easier or harder. Notice how a new software update changes people's habits. Do the same in healthcare. If you're focusing on biotech firms, keep tabs on which treatments are gaining traction among patients and doctors. Keep tabs on which treatments are gaining traction among patients and doctors. By blending real world observations with basic research, you uncover nuances that a typical investor might miss. Once you have your circle of focus, narrow it down to three or four promising companies. Then apply what I like to call the REP scan: revenue trends, earnings stability, and product innovation. A strong revenue trend shows that demand is growing, while steady earnings suggest the company can control costs. Product innovation tells you if they're leading to pack or just copying others. The REP scan is simple but effective. It quickly shows whether a company has potential for long term growth or if it's just riding a short term wave. By limiting your picks to only a handful of stocks that pass this test, you avoid the trap of scattering your money too widely. Imagine how resolving this objection changes your life. You go from feeling clueless to feeling in control. Instead of guessing which stocks might work, you have a structured way to pick them. This method helps you connect with personal interests with cold, hard data. The result is a sharper focus that can help you beat the market over time. You'll also be more confident because you truly understand your choices. When the market dips or a negative headline appears, you won't panic. You'll know you selected your stocks for reasons that go beyond short-term hype. Beating the S&P 500 isn't about having the biggest watch list. It's about having a purposeful one. When you concentrate on a few industries and run the REP scan, you develop genuine expertise. That expertise can lead to stronger returns, even if you only hold a handful of stocks. Overcoming the belief that you can't pick the right companies frees you to invest with clarity and purpose. You stop chasing every rumor and start building a portfolio aligned with your knowledge and curiosity. So, the next time you see many choices, focus on a few industries you love and apply the REP scan. That's how you'll truly surpass the S&P 500. Terrified of losing money, discover the fear-busting tactic that beats the market. Fear can be a powerful force in investing. When you're putting your hard-earned money on the line, the thought of losing it can make your stomach twist. I've met countless people who are so afraid of losses that they hold back, never buying a single share. Others jump in but bail out at the first sign of trouble, locking in losses that might have been temporary. This fear can be paralyzing, and it certainly makes beating the market a tough goal. The limiting belief goes like this: if I try to outperform the market, I'll end up losing everything. People cling to the idea that active investing is a gamble and that they aren't equipped to manage the risk. But here's what I want you to understand: risk is something you can shape, not just something you endure. With the right approach, fear stops controlling you, and you gain the freedom to make informed moves. One creative way to conquer fear is what I call the small steps strategy. Instead of driving in with a big lump sum, start with a modest position in a single company you've researched. Keep it at an amount that doesn't make you lose sleep. Then observe how the stock behaves over a few months. Notice that prices can fluctuate daily, yet the company's fundamentals might remain stable. After a while, add a bit more to your position or choose another stock you believe in. The goal is to learn by doing without letting fear dominate your every move. But here's the overlooked twist: create a personal loss threshold. This is a number like 5 or 10% of your total investment that you're willing to see go down without panicking. It's personal because some people can handle a 10% dip without blinking, while others freak out at 3%. By setting a personal threshold, you define your comfort zone. When your stock dips within that range, you remind yourself that it's still part of your plan. If it dips below your threshold, you revisit your analysis. Did something fundamentally change about the company, or is it just normal market fluctuation? This structured approach is far better than letting your emotions run wild whenever the stock slides by a few percentage points. Overcoming fear has huge benefits. First, it helps you hold positions long enough to see real growth. Good companies need time to prove their worth, and selling too soon out of fear can rob you of potential gains. Second, you become more consistent. Instead of hoping in and out, you stick to a plan. This steadiness often leads to better returns over the long haul, which is exactly how you can beat the S&P 500. I've seen many investors freeze or flee at worst times because they never addressed their understanding fear. By using the small steps strategy and the personal loss threshold, you retrain your brain to see market dips as opportunities rather than disasters. It's like building a muscle. The more you practice controlling your reaction to losses, the stronger your investing mindset becomes. Another aspect is to reframe losses as tuition for market education. Even the best investors face losing trades. The question is, do you learn from them or do you let them scare you away permanently? If you examine your losses honestly, you might find holes in your research or emotional triggers you need to manage. Each lesson learned brings you one step closer to a more robust strategy. Over time, You might even welcome small setbacks because they sharpen your decision making process. I want to emphasize that fear won't vanish. It's human nature to worry about money and security. But by turning fear into a tool for setting boundaries, you transform it from a barrier into a guide. You don't ignore the risk, you define it. That's how professional investors operate. You can effectively do it. You might not have a research department behind you, but you don't have the power to plan, observe, and adapt. Confused by company numbers? Uncover the secret technique that levels the playing field for stock market investors. Many investors feel lost when it comes to digging into a company's financials. They see terms like free cash flow, earnings per share, and debt to equity ratio, and feel they need a finance degree just to understand them. This sense of confusion can stop you from even attempting serious analysis, making you rely on rumors or simple guesses. That's hardly a winning strategy if your goal is to surpass the S&P 500. The limiting belief is I'm not qualified to interpret financial statements or company data, so I'll never truly understand what makes a good investment. This belief feeds on the idea that you need to be a math wizard or a professional analyst. But in my experience, you don't need to master every formula. You just need a basic roadmap to focus on the critical pieces of information. I have a creative framework for this called 4 Pillar Snapshot. It's designed to keep analysis simple but meaningful. The 4 pillars are profit, people, product, and position. Let's break it down. Profit. Instead of memorizing every accounting term, focus on whether the company is consistently profitable. Look at net income trends over the past few years. Is it going up, is staying flat, or dipping? Check if the company generates positive cash flow. You don't need to dissect every footnote. Just look at whether money is actually flowing in. People. Who's running the company and what's their track record? Do they have a history of leading successful projects? Or have they jumped from one failing venture to another? Leadership matters a lot. A strong team can steer a company to growth, even in tough markets, while poor leadership can sink it quickly. Product. What exactly does the company sell? Is there consistent demand for it, or is it just trendy for the moment? Is the product or service unique, or can competitors easily copy it? Sometimes a simple check of consumer reviews or user feedback can tell you more about a product's real value than any fancy metric. Position. This is about market share and competitive advantage. Even a great product can struggle if bigger players overshadow it. Does the company have a moat, something that keeps competitors at bay? Think about brand loyalty, patents, or specialized technology. If the company holds a strong position, it's more likely to keep growing. Now, here's a twist that most people overlook. You don't have to do all this analysis alone. Form what I call a mini board. This is a small group of friends or colleagues who also invest in stocks. Each person tackles 1 or 2 pillars for a company you're all researching. For instance, you might handle profit and position, while someone else looks into people and product. Then you meet, virtually or in person, to compare notes. This spreads the workload and lets you see angles you might miss on your own. By pooling your perspectives, you get a richer understanding without multiplying the hours you spend. When you have clarity on these 4 pillars, you'll feel more secure about your stock picks. You'll know why you're investing rather than just following hype. And that sense of security helps you hold onto your positions longer, which is essential for beating the market. You also become better at spotting red flags. If a company's profit starts shrinking or the leadership changes abruptly, you can decide whether to sell before losses pile up. Overcoming the belief that you can't analyze companies is a game changer. Once you see that basic analysis isn't rocket science, you unlock the door to deeper insights. You'll actually enjoy reading quarterly earnings or scanning consumer feedback because you know what you're looking for. That excitement can fuel better research and stronger returns. The four pillar snapshot doesn't require advanced math. You focus on profits, the people in charge, the product's real world value, and the competitive position. If you apply this consistently, you'll find companies whose fundamentals point to long term success. While others chase rumor driven stocks, you'll build a portfolio rooted in solid facts. By mastering this simplified approach, you turn a daunting task into something approachable. And that's precisely how you can outdistance the S&P 500. So, start small, pick one company you like, examine its pillars, and see if you can spot strengths or weaknesses. Then branch out. As you might gain confidence, you'll realize that clear analysis is your ally. Rather than an insurmountable wall, it becomes a stepping stone on your journey to surpassing the market. Believe you can't beat the stock market pros? Uncover the hidden flaw in the efficient market myth. Some investors have heard a theory called the efficient market hypothesis, which suggests that all available information is already priced into a stock. According to this view, it's nearly impossible for an individual investor to consistently beat the market. This idea can breed skepticism and the feeling of why bother trying. The limiting belief here is markets are so efficient that no ordinary investor like me can realistically gain an edge. Because of this, many people settle for just matching the market through index funds. There's nothing wrong with that approach, but it's not your only option. Real world evidence shows that certain investors do beat the market over long periods, even if efficient market theory claims it's tough. I like to challenge this skepticism with a concept I call targeted inefficiencies. While it's true that markets are quick to absorb obvious data, like earnings announcements or big news events, there are still pockets of opportunity where information doesn't spread evenly or isn't interpreted correctly by the majority. For instance, smaller companies often don't get the same media coverage as large, well known corporations. If you do the homework, you can find undervalued gems that most people overlook. Here's the creative twist: think of the market like a massive library, where books about huge companies are always checked out and heavily annotated. Meanwhile, books on niche or lesser known companies gather dust. If you decide to read those overlooked books, you might discover storylines, unique insights that nobody else is paying attention to yet. That's how you can find a stock that's mispriced or underappreciated. Additionally, certain trends might seem obviously in hindsight, but few investors position themselves early enough to benefit. Maybe you identify a shift in consumer behavior or a technological breakthrough well before the mainstream media latches onto it. When you invest in a company that's poised to ride the wave, you gain an edge. Efficiency is about the speed of information, but humans interpret data with bias. Many still react emotionally, buying late, selling early, or ignoring the signals that go against the crowd. If you can stay rational, you can exploit these emotional inefficiencies. Another angle is specialization. If you become truly knowledgeable about a specific sector, say semiconductors or electric vehicles, you might notice emerging industry patterns that casual observers miss. Market efficiency depends on countless participants making informed decisions, but many participants do surface level research. Your deeper focus can pay off in the long run. When you overcome skepticism about beating the market, you become more proactive and less fearful. Instead of resigning yourself to average returns, you start searching for that extra edge. This can lead to disciplined study, more strategic picks, and a stronger portfolio. Yes, it requires effort. But if you're determined and curious, it's possible to do better than the index. To keep yourself grounded, measure your performance over meaningful time frames, like 3 to 5 years, rather than just weeks or months. The market can be random in the short term, but good choices and thorough research tend to shine in the long run. Also, diversify across a few sectors you understand well. That way, if one bet doesn't pan out, you're not left hanging by a thread. The reward for moving past the belief in hyper efficient markets is significant. You embrace the idea that you can find a corner where your knowledge or research pays off. You realize that the crowd sometimes moves in predictable, emotional ways. If you stay calm, read the signs, and focus on undervalued opportunities, you can build a portfolio that outperforms. It won't happen every single quarter, but over years, these targeted inefficiencies can add up to a real advantage. So, yes, the markets are often efficient, especially for big famous stocks. But efficiency isn't perfect. Look for neglected areas, dig in deeply, and trust that your specialized effort can uncover hidden value. When you find it, hold tight to your conviction. That's how you rise above the market's baseline and prove that not everything is already priced in. Sick of replaying old stock market losses? Uncover the game-changing trick to rebuild your confidence and beat the S&P 500. Sometimes the hardest obstacle to overcome is your own past. Maybe you bought a hot stock once and watched it crash, or you listened to someone's tip about a breakthrough product, only to see the company file for bankruptcy. Experiences like these can leave deep scars. They make you doubt your ability to pick stocks and even question whether anyone can truly beat the S&P 500. The limiting belief sounds like, I've been burned before, so I'll just make the same mistakes again. This mindset can keep you on the sidelines, unwilling to risk another bad outcome. But here's the truth: a single bad experience, or even a string of them, doesn't define your future in the market. You can learn from these events and become a better investor if you approach them with the right mindset. I suggest a method I call the experience autopsy. Just like a doctor examines a patient to find the cause of a death, you examine your failure trades to uncover the real reasons they went south. Maybe you relied on hype instead of fundamentals. Maybe you panicked when the stock dipped and sold at the worst time. Maybe you overlooked the company's debt situation. Write these points down. Be brutally honest with yourself. Instead of running from these memories, study them. The goal isn't to beat yourself up, it's to extract lessons that can guide you forward. The twist that people rarely do: create a recovery blueprint based on each failure. If you sold too early before, commit to a holding period rule now. Perhaps you hold any stock to buy for at least one earning cycle, unless something catastrophic happens. If you jumped on hype without research, pledge to use the four pillar snapshot before buying anything new. By turning each painful memory into a specific guideline for the future, you transform mistakes into stepping stones. Overcoming past failures carries big rewards. First, you lighten your emotional baggage. Instead of letting regret shape your decisions, you treat this experience like data points. Second, you forge a more disciplined approach. Every rule to add to your recovery blueprint reduces the chances of repeating the same error. Over time, this leads to a more systematic way of investing, one that's built on reflection and growth rather than reaction and fear. I've seen countless investors who let one or two bad picks define their entire outlook. They assume they're just not cut out for active stock picking. But the best investors I know all have battle scars. They've faced down market crashes, sector meltdowns, and their own emotional mishaps. What sets them apart in their willingness to learn and adapt? They see each failure as a tuition payment for a stronger future strategy. Also consider small scale test runs. If you're still wary after a big loss, dip your toes in with smaller bets. Apply the lessons you learned from your past mistakes, but keep the stakes low until you regain confidence. This prevents the pressure from overwhelming you again. As you see positive outcomes from your improved method, you'll gradually trust yourself more. Nothing rewrites a bad experience like a good one. The key is to set yourself up for that good experience by avoiding the errors you've already identified. Think of it like a sports team reviewing game footage. The point isn't to wallow in defeat, but to find better plays for the next match. With each improved play, you move closer to beating your old record. And in market terms, that means surpassing the S&P 500. So, if prior failures are haunting you, don't shove them aside. Dissect them. Build a recovery blueprint with concrete steps that address the real reasons those trades went wrong. Then ease back in at a level you're comfortable with. Over time, you'll see that you are no longer the same investor who made those mistakes. You're wiser, more cautious when necessary, and braver when opportunity knocks. That shift can be the difference between staying behind and finally reaching the heights of market outperformance. Thanks for watching. If you found this video helpful, please hit the subscribe button and ring the notification bell. That way you'll never miss any of my new tips on how to outpace the S&P 500.